Healthcare is one of the biggest expenses most of us face in retirement. But what if you could set yourself up today to save your future self thousands of dollars? In this episode, we're diving into the powerful role health savings accounts, or HSAs, can play in retirement planning. I'm your host, Ryan, and this week I'm joined by Bob, Sean, Nick, and Nora. Sean, I know this is something we talked about recently. Want to go ahead and get us kicked off?
Yeah, absolutely. It's one of those investment vehicles that a lot of people are just kind of unsure about. So that HSA or health savings account is there for people that have a high deductible healthcare plan. So not everyone has the ability to do it, but a lot of people don't know that they can invest in that HSA. So a lot of the plans allow people to put their money in investments, allow it to grow, and they put it in there on a tax deduction basis. It grows tax free. And when they use it in retirement, they also get to use those expenses completely tax-free. So it's a triple tax savings investment vehicle that could be very powerful for someone's portfolio.
Yeah, and it's something that is not only great for the long term, can be great for the short term as well. But one thing I talk to clients about, and even do myself sometimes, is as I put money into the HSA, though I can use it that month, that year, whenever to pay for some medical expense on a tax free basis, oftentimes I'll just continue to pay for medical expenses out of my checking account and let that HSA continue to grow and build up over time because of the long-term tax-free benefit of it. So it's something that, is useful today, but really in the scope of long-term planning can be really useful for the long term.
And Bob, even if you do continue to pay out of pocket for some of those medical expenses today, you can save those receipts and then let that money grow tax free in an investment vehicle. And then when you're ready in retirement, you can actually reimburse yourself retroactively based on a couple certain criteria, but you can reimburse yourself as long as you have those receipts, you're tracking that, as long as you didn't, from a tax standpoint, didn't itemize those deductions. So that can be extremely powerful. If you're worried about that HSA getting too big and not being able to spend it fully in retirement, keep those receipts and then reimburse yourself retroactively.
Yeah, that's a really good point there, Nora. It's gives you a lot more flexibility with when and how to use it, and takes advantage of the tax benefits associated with it.
Yeah, we've even seen it like more recently as a planning tool for folks, pairing it with like an inherited IRA, because that's the inherited IRA is an account where you have to take funds out of it, right? And it's all taxable income. And so you can pair that with a bunch, you can kind of cluster it together, HSA contributions. And so you're essentially shifting the assets from the inherited IRA vehicle, which has a timer and just repositioning it into a vehicle in your own name that has that super long runway for tax-free growth and just more flexibility. That's one of my favorite features about it, and like fun planning things, even though planning's not really fun. The investing part's the fun part. But as fun as planning can go, that's as good as it gets.
Another
Well,
good,
and
go ahead, Bob.
good point there. Yeah, I'll go quickly here, Sean, but a good point there, Nick, or something to consider. So, a lot of folks, when they think about their HSA, it is tied to their employer, as Sean mentioned. But when you make contributions to it, you can do it on a payroll deduction basis, very similar to a 401k. But you're also able to go back and just stroke a check, right, to cover a calendar year for it. So, if I'm just going to make up some quick numbers, let's say the HSA limit is $7,000 and you only do payroll deductions for 2,500 over the course of the year, you can still write a check before tax time to get that deduction to the HSA for the prior year so that you make sure you're fully funding that HSA. So utilizing an inherited IRA, as you mentioned, Nick, can be a great way to do that.
Yeah. And from a planning perspective, right, we always like to tell people Fidelity comes out with a study every year that says what it should cost a retiree to spend on medical expenses every year. And so Fidelity's 2025 number was $172,500 per person. So if you think about that, it's about $45,000 as a couple that you're going to spend on medical premiums, deductibles, all of those things in your retirement. So if we can build up an HSA through an investment vehicle that reaches $350,000, you can essentially have no medical expenses in retirement when you don't have any income coming in. It could be a very,
Mhm.
very powerful investment vehicle for people. But then it becomes, what happens if I don't use it all? right? So there's a lot of different strategies that you can use after you pass away to make sure that money gets to your heirs.
Yep. And the interesting thing to know about that, though, Sean, and really the only downside I see in HSAs generally, or I wouldn't say downside, just something to be aware of, is when it does transfer to a beneficiary that's not a spouse, they are required to take the entire balance as a taxable IRA distribution in the year of passing. When you pair this together with, Roth conversion planning and general just inheritance planning, you want to make sure that you're focusing on spending this down during your lifetime if you can, right? We all can't control how that's going to happen, but to the best of our abilities, we should be trying to utilize this during life of the owner and not trying to necessarily pass it down. So it's an important consideration there, Sean. It's a good point.
I say if it does go to a spouse, that spouse can take that HSA and make it their own HSA. So if someone does pass away early, they can move the money over. They can go through their medical expenses during their lifetime, and it can continue to grow on a tax-free basis.
Yeah, when you're thinking of trying to get to that $350,000 number, whatever it is, know that an HSA is similar to like a 401k or an IRA, where the IRS sets maximum numbers each year, whether that's going to go up, stay the same. So this year for 2025, I believe it's 805 or 8,550 for a family. So just make sure that you're putting that into consideration when you talk about financial planning. And with an HSA, which is unique, you and your spouse both can't max out an HSA at an employer. So if you're contributing for a family, it's all inclusive. So whether just one spouse maxes it out or you do half and half, just make sure that you're aware of some of those or you'll incur some.
And great point there, Nora. One more thing to add there is that the employer contribution, so if your employer puts money in there for you as well, that counts towards that maximum contribution. So you cannot personally max it out and get something from the employer. It's a combined number that is the max you're allowed to do on an annual basis.
And oftentimes employers will kind of give you two options, and we get a lot of questions about that is I have an HSA and I have an FSA, a flexible spend account. Which one should I use? So there's a key distinction there. So the flexible spend account typically disappears at the end of the year. So if you put money in there and you don't use it, right, you lose that money. Whereas an HSA allows you to grow tax-free, rolls over every year, can continue to grow. So we typically recommend the FSA to people that have childcare. And let's say their childcare, because those bills are outrageous right now. Let's say that's $40,000 and you put $7,000 in your FSA. Not a bad strategy. You're getting a tax deduction. You know you're going to use it. But all of a sudden, your kids stop needing childcare. They're in school. You don't want to have a flexible spending account balance because you lose those funds. Whereas an HSA, they could be used for healthcare for the rest of your life. So a key distinction between an FSA and HSA, and a lot of confusion that we hear questions about when we meet with people.
Yeah. Funny
Yeah,
how
and
the
just know within
FSA
a
is less flexible, right? Like, how did that happen?
Yeah.
The only like in addition to all that too, like clustering together, like say that you don't have a high deductible health plan right now, like it may be worth it during open enrollment time to change to one just for the purpose of getting dollars into the HSA bucket and then continuing to fund your medical expenses otherwise, or even doing that for like a year or two when you have other big taxable income coming in. So like these are not like you have to do this forever for like a 20-year commitment. Like you can go high deductible plan and then change to a non-high deductible plan and you get to keep your HSA still and can still use it. You just can't add to it unless you're in that high deductible health plan. So it's way more flexible than the FSA as a misnomer for sure.
Yeah, Sean. And another question that we get a lot of the times with clients is, well, you talk about all these advantages of an HSA and contributing through it, whether it's just from a check annually or through my employer, but how do I go about investing? And that's something that we can help you work through. And we've worked through, helped a lot of clients either one, work through their employer through the options that they have from a custodial basis, or we can work and help open one through third parties and through our systems as well here. So if you have questions about how do I invest, I know I'm contributing, but where is it or what do I invest in? That's something that we can help you with.
Yeah, great point, Nora. And with the investment side of things, right, like it's very similar to a 401k. As you move from your employer, say you have one currently at your employer and you go and change jobs, you want to do the same thing with those dollars. You want to roll them out and push them to a account that you're more active in managing and keeping track of, and not just leave it at the custodian or the setup that was with your prior employer. So make sure if you're leaving jobs, you're doing the same thing you would with your 401k with your HSA dollars, so that you keep track of them and can keep them growing going forward in the future.
Awesome. Thanks everyone. Great discussion there. I think this kind of helps shed some light on the power that you can get from an HSA, the only triple tax savings investment vehicle available to you as you're kind of growing that nest egg, getting ready for retirement. So with that, we're going to say Bob is our winner of the week. So I'm going to go ahead and hand it off to you, Bob, for your 60-second rant. What do you got?
All right. Well, just this past week, week 1 of the NFL kicked off. I am a Browns fan. It was painful to watch that game. I read a statistic that we gave up 7 net yards in the second half and still lost that game. So, it's frustrating as a fan to know that you could have won it just with the kicker not missing 2 chip shot kicks, and that the defense is strong. But I still have the belief that the Browns are going to be good this year. I think we've got a defense. I think we've got a quarterback that can run the offense, and we'll see what happens. But week 1 kicks off. It's another frustrating start for the Browns, and certainly hopeful for better things coming in the future.
Not a chance, Bob. Not a chance.
Yeah, we'll see. I don't know.
I think the Broncos had 7 net negative yards for their defense in the second half, by the way. So,
but they won.
And we won the game.
Yeah.
Nice one, Bob. I think we can all agree that week 1 of the NFL is always weird, kind of getting the hang of where everyone's landed on the different teams and who's good or not. But it was a fun watch this past week. But thanks for joining us for another episode of Balance Your Wealth, and we'll see you next time, everyone.